Hi friends, Kurt Triebold here from One Tree Hill reporting to you on this week's market update. The second quarter earnings season is almost over and corporate America delivered. In short, earnings blew away expectations. With 92% of companies having reported results so far, the average upside surprise has been a whopping 22%, which we believe is the highest ever on record. We think estimates were off mainly because corporate guidance was simply lacking of accurate detail. Analysts vastly underestimated companies' ability to contain costs. They were also surprised by the U.S. economy's ability to bounce back so quickly as states reopened. Analysts far underestimated the size and impact of fiscal and monetary stimulus by our federal government, and retail sales were far stronger than what was expected. So now what? Here are some interesting observations that might help us peer into the near future. 1. All of the earnings decline came from just 4 sectors: consumer discretionary, energy, financials, and industrials. This means every other sector had bounced back to about even for the year collectively, all during one of the worst quarters in U.S. history. 2. The past pandemic performers were mostly on the growth side. The so-called stay-at-home stocks, whose leadership positions have only strengthened during the pandemic, think Amazon, are mostly found in growth indexes, big cap technology and internet stocks in particular. We continue to believe growth style stocks will outperform over the near term, even though value has done well recently. Unexpected upbeat third and fourth quarter guidance being offered by corporate America as a whole is a positive. And lastly, the dollar has played a bigger hand than expected. Dollar weakness boosts international source profits for U.S. multinationals. We see this trend continuing, and it plays well for the near-term earnings outlook. Of course, caution is still warranted, and we don't want to overplay our hand. Here are several issues that we're still concerned about. We think a pullback may be overdue and probably would be healthy. The election could drive volatility. The next leg of the economic recovery may get tougher. U.S.-China tensions are ratcheting higher. Stocks may be disappointed if lawmakers can't agree on another stimulus package. Municipal and state budgets may be under more pressure than reported. Unexpected COVID flare-ups and potential vaccine disappointments could also bend the current positive trajectory of our economic recovery. So in short, we are all thankful for the current valuations, and things seem to be looking brighter, but we're not out of the woods yet, and there's plenty of risks that could trip us up. So cautious optimism should rule the day. That's it for this week's market update. Stay well, everyone.